Thank you for those that have attended today and the panelists that have joined us again. This is the first in a series of Friday Q&A sessions. I hope you're all keeping well and you've had a good Easter, albeit in rather unusual circumstances. So we've got our original group of panelists, Todd Gamble, Peter Benbrick, Nick Noonan and Betty Preshaw. They will very kindly give us a bit of an update on what's been happening since we last talked, some of which you may be aware of, some of which you may not. Please feel free to post questions as we run through in the Q&A box. And we may answer some as we move through and then catch up with the rest of the questions at the end. So without further ado, I'll hand over to Todd to kick us off today. Todd.
Thanks, Tony. Good morning, everybody. Afternoon. I will just run through quickly a lot of the things that we went through in the webinar that we sent the link out to on Wednesday. A lot of those things haven't changed. The major things that we are starting to see is people thinking about how they fund JobKeeper if they need to, because of the timing difference between when they actually get the JobKeeper payment in May and what they actually need to do now in April to be able to pay for it. So in terms of actions and whatever else, there is some focus around moving through a process and getting an action plan together, understanding how that all fits in terms of an overall position, and then the funding options as well as part of it. Then if you need to, get a safe harbour review or an independent review. And this is all sort of tied in with what's happening with JobKeeper, as people are having to actually look at their forecasts and make sure their forecasts correlate with eligibility as well. So there's a lot of these things that are being done, and I'd suggest that you need to do it, you try and get it done once, so you have a consistent approach and it's easy to understand, and that everybody can then use it for things like the ATO, for JobKeeper, for the bank, and then anybody else you need to provide it to, like landlords and whatever else. So, and then it also allows you to monitor it and make decisions as you go forward. So that's it at a higher level. In terms of the value add sort of things that we're seeing, basically the major things are adjusting, Nicola, next page, the GST and how that all works. No, okay. So the other things we're seeing in terms of value add, payment arrangements, so cash accounting for GST, so people moving back towards that and making sure that they're not paying GST on revenue that they haven't got yet, and making sure that their bad debts are adjusted so that they hold on to as much cash as they have without using it to pay the government. In terms of the Kerry Packer rule still applies, don't give them anything more than you have to. Stand down, the other thing, as Nick raised last week and Nick will talk to a bit more, stand down you need to be careful about, because it may not be the best long-term position and it may create more havoc than what it solves. The other thing is looking at security for related party funding and making sure that people who are putting money in, that they get security over that to protect that funding and make sure that their family wealth that they're putting at stake to be able to fund their businesses is protected. This will also help with restructure at the other side, because it'll give them a security position that needs to be dealt with no matter what happens. And then the practical things we're now getting to is, although people are sort of getting their head around a hibernation plan, what are they going to do about new stock and rent and funding for that out the other side, and how they actually run their teams, whether they split their teams returning to work, and whether they have 4-day weeks to minimise any opportunity of further spread, and also with their clients and customers, effectively create understanding or doing a plan of how they can operate with long-term social distancing, which it appears that that'll be in, no matter if there is a release of some of the lockdown, social distancing is here to stay. So that's pretty much where we've been going to. I'll hand over to Pete. Pete's been having a lot more fun with JobKeeper, and everybody loves hearing about how you can get cash. So that's more important than probably what we've been doing at the moment, but everything else flows off the back of it.
Yeah, absolutely. Yep. No, thanks, Todd. So yeah, obviously that slide there summarises all of the the key measures, but and it seems such a long time ago that some of these things were announced, like the instant asset write-off. But the last week and a half has certainly been all about JobKeeper. So that's been occupying all our attention. And as Todd indicated, there's so many flow-on effects and associated practical and commercial aspects of that. So what I've been spending a lot of my time on is looking at the real mechanics now that starting last weekend, but in particular when the ATO actually, Treasury started announcing some more specifics and updating their fact sheets, and they released the rules, which more or less broadly mirrored those previous fact sheets. And I'm sure a lot of you have heard and read a lot of that detail already, and getting to, okay, well, what when, but now we're really getting down to brass tacks, I guess, in terms of, how do you actually get in some of the real practical issues that were arising. So I think this is where some questions, some of you have probably got some questions that might be useful. I'll just go through a couple of the points that we've seen, and then, interested in other points, the other queries that people might have to raise. But you all know that, I think they all know the basics. The turnover tests, those of you that have multinationals would certainly, or larger clients, the $1 billion. So it's interesting that they've, we've got two different concepts of turnover here. So you've got to start with turnover in the Tax Act. So $1 billion, similar to all the rules around multinationals, $1 billion turnover on an aggregated turnover basis in the Tax Act. So that means if you are a small subsidiary of a multinational, global turnover is still relevant. So that might knock out a few client businesses like that in that sort of category. But that'll something we'll have to look at. But then you get into the assuming and that just means that then they're up to a 50%, and that's going to be just a harder hurdle to satisfy. But assuming you're still in the 30% category, or if you're dealing with not-for-profits, 15%. There's certainly quite a concession around charities and gift deductible entities. But for your typical business clients, where 30% is the relevant threshold, looking now down to the specifics of how do you look at your turnover? Picking a turnover period. We're about to start doing BASs, so you could look at your March quarter or your month of March BASs. It's clear that you can pick and choose the period, so it doesn't just depend on the data. May come off the BAS, and a lot of the data might simply be on the BAS. But when you get into the application process, you really got to look for your clients about what is going to give them the best outcome, and how do we get them in. And so, for example, you might have a quarterly lodger, even a monthly lodger, but if you're having difficulty with the month of March, say for example, you might want to look at a quarterly period starting with the June quarter. So projecting what June quarter is going to look like. If you can establish that 30% reduction for June quarter compared to June quarter last year, that might get them in. And the good thing about this is once they're in, they're in. So it's the whole thing. The whole trick is going to be getting them in the first place, and then getting through, and we're really starting to get down to the mechanics now of going through that process of helping our clients if they're going to need our help with applying, or at least guiding them with applying. Probably one other key point I might note, and then probably Tony, if people have questions now, that might be useful. If
they do, Pete.
Pete. Well, maybe just before I get to that, I might just note that GST grouping, and people might have, they might have. If you've got clients in GST, I've got one particular one that I've got, which I think is definitely impacted. They've got in multiple employer entities in a GST group, but only one main trading entity. And it appears, that does appear that that is going to be the. You look at it; it's quite clearly defined as far as I can see that you apply it on a standalone employer basis. So, if the only revenue of some of those subsidiaries is a recharge of costs, then you may find that it's hard to actually demonstrate a reduction in turnover. It might flow that if the scale of the business is down, that might also be down, but that won't always follow. So it's going to cause some interesting scenarios, and there may be it's something we have to look at a bit more closely anyway. So maybe, Tony, we should look at some of the specific questions.
Sure.
So are they under Q&A or chat?
Yeah, they're under Q&A, Pete. So
okay.
Rather than me read them out, you can see
them.
Yeah,
I'll look at them. I'll look at the three there's just three that are there anyway.
Yeah.
Okay, yeah, no, that's a point, and so that first question, which Mike raises, if everybody can everybody see the questions, Tony? Yeah,
Yep.
yeah. So about GST turnover, there is a good point there that strict definition is value of supplies made. So that is the understanding that we have, is that you make a supply in a month or a quarter in a period, then that's how you should measure the turnover, which most people are just going to look at the BAS numbers, and probably a lot of the time suspect that there's a lot of intention of being concessional here. So they're looking for people. The ATO is certainly looking for people that are obviously doing something that's obviously manipulating the rules to get slip under when they shouldn't really qualify. So if you're applying this in good faith and using your BAS numbers, you're probably going to be okay if it's fairly obvious, or a lot of the time will be fairly obvious. But the point is technically right, that if you might be a cash basis reporter, but if you look at supplies made in the period, that really is more of an accruals concept. So and more guidance may come out on this, but to directly answer the question, I'm not sure that there's any specific allowance in the rules for using simply cash, which is a bit odd given that some businesses clearly are cash reporters. But the practical answer probably will be if you're using cash and you're using the BAS figures, then you can clearly show a reduction. If it's not line ball, then I don't think it's going to be too much of a problem. But it's something to. So I wouldn't get too hung up on that point, but it's definitely something to think about. So hopefully that highlights that point for everyone and answers the question for Mike there. So Mark's question about so that we're getting into the actual lodgement process now for the reduction. So really you've got to look and look. I've looked more at the rules than actually the registration forms as yet, but I know we're starting to get that detail just coming through. The question about is it self-assessment or declaration? Well, I think to the extent that the numbers, there's not a requirement to take numbers straight off the BAS, and it's fair to say that it can't be that way. It can't be like the cash flow boost where the ATO just automatically goes off the reported numbers, because as I said before, you could be a monthly lodger but choose to use a quarterly period or vice versa. So it's definitely going to require some sort of you're definitely going to need to report numbers, and so there has to be an element of self-assessment and declaration there. The various fact sheets and things, guidance has certainly indicated that if you're a little bit out, like if you estimate June quarter, for example, and you're a little bit out, they're not going to be they're not going to come down hard on you. But if it's way out, if it's obvious that employers have claimed it and they shouldn't have, then that's when the ATO is going to be looking at it. So there's certainly an element of being required to justify what you've done. So obviously retaining records, being able to refer back, if it's not the BAS numbers, being able to report back to your monthly P&Ls or quarterly P&Ls.
And Pete, we're seeing that as a practical basis where people are actually going, right, this is the process I've been through, and sort of getting it reviewed and having somebody ask the questions, interrogate it.
Yes.
So and that's what accountants are probably going to have to do. I suspect that's going to be part of our role in this.
Yeah, exactly right. Yeah, exactly. Thanks, Todd. So we're actually at the point right now of sending stuff out to clients with like checklists. So say, do you want us to help you? Do you know what to do to register? Do you want us to help you? What you need to do, and part of that will be, okay, do you want us to, in terms of the reporting as well? Do you want us to help you with the reporting? As Todd's indicated, you come up with something and we'll review it for you and lodge it, and help you lodge it, or we'll just review it for you. There's different ways that you could help your clients with that. So definitely, everything's. I mean, these days most things are self-assessment in some way, but as you indicate, Mark, record keeping is key. And okay, the anonymous attendee here, whoever that might be, I think the answer to that one is pretty clear. No, you don't get kicked out. You get in, and the whole idea of this is to keep people in jobs and to businesses, and Nick might have some comments about how this will play out in the marketplace. But certainly, they're not looking for people to get into the system and then keep people on and then suddenly fall out and then start putting people off again. I mean, so I think the whole approach is going to be fairly concessional, and there's a deliberate design element here that once you qualify, you're in.
Yeah, that was the thing that was raised on Wednesday in the webinar. Is that, and it was pretty definitive that everybody's view was once you're in, you're in, unless something materially changes. Right? And if something materially changes, well, you don't need to. You can pay it back at some stage. I mean,
I think Todd, that's probably more if you've either just done it incorrectly in the first place, or you've genuinely had a reasonable go at an estimate, but things have changed. So in fact, that estimate is no longer accurate, or so in fact it's become quite clear that you really shouldn't have been eligible in the first place. So there's definitely the mechanism, as Todd indicates, to pay it back. And I don't think, again, it's not unless it's obvious that they've been manipulating things. I believe there should be too hard in terms of penalties, but there should certainly be there could be an element of paying it back. But if it's simply the business generally, that was the state of the business at that point in time, and you're able to back up the numbers, remembering that it is a periodic test. So if you can show, so this is where you would look to pick and choose the periods that give you the right result, the best result. And if you pick and choose periods and you're able to show that reduction in turnover, so you meet the test, you're in there. I don't see a problem with the fact that the business conditions change later. Okay, right. So it's been noted that the panelists can't see the questions. So Todd, that might be, we'll have to. Sorry, Tony, beg your pardon. So we'll just note that the panelists can't see the questions. So I'll keep that in mind. We thought we could change that, but so I think that's the two questions here that I'm addressing. One was about if you bounce back, do you lose it? And I said no, you don't. Same point here. Do you have to reassess falling rate of revenue each month? And but again, that's all around the point that once you're in, as Todd said, and that's a pretty deliberate design feature of the system.
And the other thing that was raised similar to that the other day, a practical issue is that Treasury guidance is different to what the ATO has said, and particularly around how the assessment works. And the ATO are the party doing this, and the ATO are the party governing it. So everybody is working towards the ATO governance now, rather than Treasury, who are probably simply paying for it.
Yeah, well, Treasury, and to be sort of a little bit in a technical sense, because again, we were taking things in order. We were waiting for legislation last Wednesday, which we knew was coming, or we were ready to analyse it. Turned out that there wasn't much detail in the legislation from our perspective. That gave all the power so the legislation that Parliament passed gave all the power to the Treasurer to make rules. So then over the weekend we got the Treasury legislative instruments that made the rules, which was largely consistent with Treasury fact sheets, and that also allowed powers could be delegated to the Commissioner of Taxation. So yeah, to Todd's point, that's a sort of a flow-on effect, is that the framework was legislated, the Commissioner has then exercised the powers to set the detailed rules, but then the actual day-to-day administration is the ATO's job. So now we're at that point where the ATO is, as long as it's consistent with the broad rules of Treasury, then the ATO will be actually dealing with a lot of the practical applications. And I noticed that there's now set up dedicated teams and email addresses that allow tax. Well, to start with, there's a section on the ATO website that for employers, employees, and tax practitioners. And there's also an email address that allows practitioners to sort of send in questions. So we're getting to the point where, as Todd's indicated, ATO is going to be the one that's going to be providing us that detailed guidance.
Thanks, Pete. Mark's also asked another question, but I think you've already answered that. You don't need to reassess the fall in revenue each month, right?
No, that's right.
Okay. All right. So over to you, Nick. Thank you, Peter.
Yep, I'm done. Thank you. But I'm happy to cover any more
Thanks, Tony.
questions, but that's enough probably for now.
Keep the questions coming.
Thanks, Tony. Thanks, Peter. A lot, as Peter foreshadowed, every day seems to result in a new development here. I did this presentation last Monday, and it's almost an entirely different presentation on the basis that even though I spoke at a high level about JobKeeper, at that stage, JobKeeper hadn't been legislated. It was legislated on the Wednesday. And surprisingly, even though all the talk about JobKeeper prior to the legislation being released was that JobKeeper was essentially a sort of payment regime, a facilitation of wage subsidies through employers to employees, when the legislation was announced, a lot of the amendments that were made were amendments to the Fair Work Act. And it actually gave a lot of new powers to employers and new obligations imposed upon employers in relation to how they treat their employees during the JobKeeper period. So my presentation last Monday was about the existing rules in the Fair Work Act about standing down employees and alternatives to stand down. And what I said in that presentation was that the existing legislation about stand down was quite confined, and I thought that there was a real possibility that there would be a lot of disputes about stand downs that had been affected under the Fair Work Act, the existing provision. And what I've seen in the last week is some of those disputes playing out. Like I've got a matter on at the moment which involves employees who were stood down by their employer under 524 of the Act, which is the existing provision. This is a business that was not necessarily shut down by virtue of one of the government directives, but clearly was suffering the indirect impact of COVID-19 with less demand and less revenue. So decided to stand down employees under the Fair Work Act. Those employees immediately lodged disputes with the Fair Work Commission. There is a specific avenue for employees to lodge stand down disputes with the Fair Work Commission. So my client spent the end of last week in the Fair Work Commission in a number of conferences and conciliations trying to resolve these disputes. The disputes have not been resolved. My client has now affected the redundancy of 3 of those employees. And what the client is now dealing with is the Fair Work Commission still wanting to hear and ultimately determine the question of whether these initial stand downs that happened 3 weeks ago were lawful and valid under the Act. And secondly, because these individuals have been made redundant, they have all now separately lodged general protections disputes, which are an alternative type of unfair dismissal claim, but claims about their termination. So in the space of 3 weeks, he's now dealing with 6 separate sets of proceedings from 3 employees that concern these provisions. So it's a good example of how contentious they can be. And I expect to see some more challenges to stand downs in the next few months. But what I might do is just deal briefly with the new JobKeeper related stand down provisions. I talked last week about the existing Fair Work Act provisions, some alternatives to stand down, which are important. And the emphasis with the alternatives to stand down are looking at employee agreement as opposed to direction. So agreement to things like taking leave without pay, taking pay reductions, working alternative days. The extent to which you can obtain employee consent to those things will go a long way to reducing legal risk, because the Act, and including the new JobKeeper provisions to the Act, make it very clear that there's nothing that precludes employers and employees from reaching separate agreements, provided that the agreements that they reach are lawful. So a good example would be reaching an agreement with employees to take a pay reduction, which is entirely lawful, provided that the pay does not result in the employee receiving less than, for example, a minimum wage rate in a modern award. What I might do is just talk specifically about, because this is really brand new content. As I said, it came out last Wednesday. I actually had to do a presentation last Thursday, which I thought was going to just be about stand down, and all of a sudden the government decided to legislate on the Wednesday night. So I had to get across this legislation overnight. But it was surprising, as I said, in that it's created a new, what I call really a watered down version of a stand down. So these new changes are in effect for the JobKeeper period. So at the moment, that's until the 28th of September this year. So everything I'm about to say gives these specific powers only for that discrete period. So what the government has done is enabled employers to give 3 different types of directions. So they are directions, they don't require employee agreement, but because they are directions, and this is really important, there is a lot of underlying protections given to employees about these directions. And there's also a new type of dispute that they have created, which enables employees to challenge these stand down directions. And that's where I expect to see a lot of activity, particularly for employees who have been stood down receiving JobKeeper, which will be, I think, reduce the risk of claims for a while. But coming at the end of this, it may be that those employees that are made redundant, like my client, will then be dealing with these JobKeeper stand down disputes. So the 3 new types of directions that are available for only JobKeeper eligible employers in respect of their JobKeeper eligible employees. The first one is what's known as a JobKeeper enabling stand down direction. And this is a direction given to an employee to work fewer days or hours, including down to nil hours. So a complete stand down. And that's for an employee who cannot usefully be employed for their normal days or hours. And it's because of COVID. It has to have a COVID link to it. So, you know, I've called it a watered down version of the existing provision. And to be honest, it answers a lot of the concerns that I had about the confined Fair Work Act provision that exists, the old one. The old one was very confined. I think there will be more disputes about it. This has addressed that because it enables employees essentially to be partially stood down. So working fewer days or hours. So basically going to part-time if they're full-time, but it can be a 100% stand down. So the second type of direction is what's known as a JobKeeper enabling direction about duties. So that is essentially enabling an employer to direct an employee to perform different duties to their usual duties. And it's more significant for award-based employees that have particular award classifications. It enables employers to have a bit of discretion to direct people to do different things. So for example, you know, restaurants that are directed to be closed and wait staff being directed to do duties that would facilitate the restaurant operating its takeaway facility, which is permitted. The other direction that is able to be provided is about location. So an employer can direct an employee to work at an alternative location, which obviously will include home. Now, what's important to note with these directions is that they apply irrespective of anything to the contrary that's in the employment contract or an award or an enterprise agreement. But there are protections and very important, I guess, procedural and documentary requirements. So there's a reasonableness obligation, which means an employee can refuse it if it's unreasonable. Now, legislation loves that word reasonable and just means for me disputes. You know, employees arguing that it's unreasonable, that gives them a basis to refuse it potentially. You can have a fight about that. There's also consultation obligations and time obligations. So if you want to, as an employer, give one of these directions, you're required to consult and you're required to give 3 days notice of the intention to give the direction, unless the employee and the employer agree to waive that period. The other thing that agreements can be reached about are an employee working different days or different times. The other one is about leave. So an employer can require or request an employee take annual leave, and the employee is required to agree unless it's unreasonable. And the protection that's given to employees is that the direction can't result in them having less than 2 weeks annual leave. Agreements can also be reached about employees taking annual leave at half pay. So it's an interesting time because it hasn't replaced the existing rules in the Fair Work Act. These are temporary rules. So you'll potentially have, two regimes operating, because you'll have some employers that are not JobKeeper eligible that will be under, the old rules. You'll have employees that are JobKeeper eligible that will be using these rules, but also there's nothing preventing employers and employees from agreeing to alternative arrangements. So it's not a direction, it's an agreement. But I do think that employers need to tread carefully because, on the one hand, these new powers given under the JobKeeper rules give employers broader scope to issue things like stand down directions, but there's important protections that are given in the legislation. One of the significant ones is about accruals of leave. So what the rules say is that notwithstanding you can give this JobKeeper enabling stand down direction to require someone to work less days, there's a guarantee built into the legislation such that a person's leave accruals and termination entitlements, if they are terminated, are assessed on the basis that the direction wasn't given. So it won't automatically result in their leave entitlements going to pro rata. They're treated at their pre-direction accrual. So things like that, I think, again, likely to result in some disputes and some confusion. So that's all I had to say about those issues.
So Nick, we've got one question from Mike.
Yeah.
There, can you see that?
Yeah, I can. I'm just reading that. Personal decision not to come to work. Yeah, that's a really interesting one, and I've had a few similar questions in the last few weeks about that. So first thing I'll say is the Fair Work Ombudsman, who is the industrial umpire, has quite sensible guidance on their website about this, but they are also very cautious about endorsing employers to terminate employment if someone is not prepared to come to work. Another important thing to say about that is there is a new, what's known as pandemic leave entitlement that has now been built into all of the modern awards. So that entitles employees who are required to self-isolate or have a recommendation from their medical practitioner that they don't work. They get an entitlement to take 2 weeks unpaid leave. Now, it won't be strictly unpaid leave if the employer is JobKeeper eligible, because the employer will be required to pass on the $1,500. But what you're getting at is a situation where an employee, really as a precaution, is not prepared and does not wish to come to work. My view on that is you're able to direct someone to attend work. Safety is obviously a big concern here. I think you'll see, particularly now with JobKeeper, a lot of employees that are now receiving JobKeeper might be of the view that they will say to their employer, I'm not prepared to come to work because I'm concerned about my safety. Employers in those circumstances will need to make it very clear that they put in place measures to ensure safety. And as long as that safety concern is addressed and an employee is not fitting within the confines of a pandemic leave, I think you've got a basis to direct that employee to attend work. The other option, I guess, and this is to avoid someone sitting at home on unpaid leave but receiving JobKeeper, is to say to that employee, if you're not prepared to work, firstly, I think that I've got a basis to require you to work, but I am prepared to agree that for a period, you can take your annual leave, which I guess is an alternative and enables you to run down an annual leave balance. But it's a good question, and I think it's going to happen more and more. There's always an argument available from someone in that circumstance that if they are terminated, like if you directed them to attend work and they refused to attend work and you terminated them, clever lawyers will argue that, that person's raised a safety issue and you've terminated them because of that safety issue, and that can turn into a general protections claim. But there has to be there has to be a legal basis to insist upon someone working where the business is open and you've addressed their safety concerns. But definitely with respect to JobKeeper, if you agree and allow someone not to work and you're not required to pay them because of that, because they wish to stay at home as a precaution, they will technically be a JobKeeper eligible employee and you'd be required to pass on the JobKeeper payment. There's no exemptions. The JobKeeper payment regime is pretty simple with eligible employees. You're an eligible employee if you were an employee on the 1st of March and you're still employed. It doesn't really get into what the person's status is, whether you're doing no hours, some hours or full time, you're treated as a JobKeeper eligible employee.
Okay, thanks, Nick. Betty, over to you.
Thanks, Tony. Thank you, everyone. So nothing's really changed when it comes to the government-backed business unsecured loans to small business for up to 250,000. So the repayments, no repayments required in the first 6 months, the P&I for the remaining term of 2.5 years, and the loans are available to the 30th of September this year. I'm just going to talk about a case study, a client that I'm currently working with that is looking to set up a facility with their bank as a contingency fund, because their business is actually heavily dependent on the property sector. So in my client's case, if the property sector was impacted by COVID-19 and their business potentially struggles, they'd like to have this contingency fund set up. So the banks are, in terms of what the banks are requiring to set up this contingency fund, you do need a good story as to how COVID-19 has impacted your business or how it will potentially impact your business. Traditional financials aren't necessarily required, but if you can provide a most recent P&L, that's what the banks are asking for, not necessarily a forecast. A forecast is required when it comes to explaining to the bank how the client will actually amortise the debt after the 6-month deferral. So amortise the debt over that 2.5 year period, because it's a 3-year loan. So the clients or the business needs to have a good story as to how after the 6 months they'll be able to amortise it to zero, and some forecasting will be required there. So that's with regards to the business side of it. With the residential side, I've seen more of, what I'm seeing more of is not necessarily people looking to defer their mortgage repayments, but more so people are looking to take advantage of some of the great rates that are out there at the moment. So there's rates as low as 2.19 or 2.09% for owner-occupied home loans. So, but even in those instances, and with regards to my pipeline customers as well that I've got who have been pre-approved, the banks are now asking for, specifically if an applicant is from an industry that will probably be impacted by COVID-19. So if they're in a face-to-face role, sales role, for example, or psychologists, or a speech pathologist was one of my clients. She's a speech pathologist, a paediatric speech pathologist. So the bank's come back in this specific example and said, can we please have a letter from the employer to confirm her base hours, her continuing base hours and her salary. So they wanted confirmation that her position hasn't been impacted by it. So, and the banks are making those changes. So they're asking it for, in some instances, the bank will ring the employer and confirm that the job, that their applicant is in their current role. So that's where I'm seeing a bit more activity when it comes to the bank, when it comes to credit assessing an application. I've got a client as well that purchased a property in early March with a view of selling their property at the end of March. So they purchased the property with a long settlement and selling their property in Bondi and expecting to get a great price because it's in a fabulous location. But COVID-19 lockdowns and the current economic conditions haven't brought them the sale price on their property that they wanted. So we're now going back to the bank to get an increase on the pre-approved amount to take into account the property that they purchased in early March, and also to keep their current property that they've got. So in this specific example, the serviceability is fine because it's not a bridging finance, it's actually servicing the whole debt. But in this specific example, we've had to reduce the declared living expenses, which is something the banks don't like to see. So in the first application, we declared X amount of living expenses, but in the second application, we're now saying, well, now we've got 2 mortgages, we're obviously going to reduce our entertainment expenses because we're in this position for the next few years. So, and the banks are actually looking at that application favourably. So it actually isn't as dire as I initially would have thought. So the banks are being quite good in that respect and really trying to, help people out when it comes to debt. So does anyone have any questions? Is there any questions here?
Yeah, there is one, Betty.
Right.
I wouldn't think it'd be too hard to reduce entertainment expenses at the moment.
That's right. Well, but that's the 12.
Unless you've got a drinking problem.
Well, that's easy to talk to for the next 6 months or, whatever we're in lockdown, but we're not applying for a 6-month extension. We're actually applying for a long-term loan. So we need to sort of say, well, even if they decide to keep this other property, how will it impact their ongoing lifestyle? I mean, in this example, they were great savers. So even though they had an existing loan, they were still saving, outside of that. So, and they were young, so, they're professionals. So they've got career progression ahead of them. So, it was a strong application. There's no reason why the bank shouldn't help them. But the stickler in this example, in this particular deal, was the fact that we declared quite a bit of living expenses, and now we were halving them really, which was which is not really. And if you're saying that you're getting another property, you'd expect your living expenses will increase because now you've got an investment property that you've got expenses for your investment property. We shouldn't be reducing expenses. So, but it looks like the bank will help them. So it's it looks good. So I've got a question.
Betty, Paul's asked a question about effectively about creditors blowing out, creditor days blowing out, and working cap finance.
If business income is stable or growing, but creditors' days out are blowing out because clients are taking longer to pay, will that be a good enough case for finance? Yes, absolutely. Without a doubt, that's a great example of someone that would potentially be able to dip into a contingency fund, an unsecured loan. Probably it'd be good to approach their existing bank as well because they've got that that relationship with them. An existing bank, I don't know if they're business banked, if they've got a business banker, but we're happy to facilitate those discussions with the banks, with their existing banker, and potentially take it, to another bank if their existing bank isn't as good so it's absolutely this is a great case. It's a good, in this example, these applicants might even be apply for debtor finance. I don't know how big the client is, but debtor finance is another solution, which is not your traditional government funding loan that we're just talking about. I've got another question from Paul saying, Westpac called me this morning, re my banking, and I mentioned, he's still typing.
So Betty, how responsive are the banks at the moment? Is the timing okay? Are people getting answers reasonably quickly?
Because Betty, one of the questions I had was, are people getting short-term funding available to be able to pay their wages that are eligible for JobKeeper? So can they get like a 50 grand overdraft to pay people and then repay it from JobKeeper, or are the banks looking at those type of things?
Yeah, absolutely. That's another great example where your JobKeeper situation would help. You could talk to the bank and say that, this is absolutely the way that they could facilitate that short-term finance. In terms of how quickly these turnaround times, it really is subject to the bank. So I'm not going to name and shame banks, but there are some banks out there that are taking I've got a deal, a residential deal that's taken 25 business days, which is really not acceptable. And yet you've got other banks that are, that are really well equipped in terms of their processing areas and are really getting through these applications. So it's really dependent on the bank. I know that Commonwealth Bank, when this whole government-backed funding was first announced, the Commonwealth Bank sent a group-wide email to all of their business clients saying, this is, in this situation, this is what funding's available to you. Let us know if you want to have a chat. And so they were being bombarded. And I know a lot of the major business banking areas are also being ambushed. And, really it's a bit chaotic out there. But things may have quietened down now. But in terms of turnaround times, it's not going to happen, within a week or 2 weeks. It would definitely, from my perspective, I would say it would take at least 4 to 6 weeks in order to have something like this set up, potentially, depending on your bank.
But a temporary overdraft, they can just allow payments through on the basis that they can just roll that. So, and other thing, Paul, I'll say to you that we're talking to our bank, which is NAB as well, around our probable accumulation of WIP and debtors that'll go forward, and we're expecting, like, depending on where we land, we could have 20 to 30% build up of WIP and debtors because timing will be an issue. And NAB's been fairly positive with us and sort of understanding that. And we're just working through that now with how we actually deal with it and what that means. But I think that will mean that we'll probably look to get a facility ourselves, increased facility, to be able to make sure we got working capital available.
Yeah, exactly. And it depends it depends on the relationship you have with your bank as well. So, I mean, obviously, firm's got a great relationship with NAB, and that's a really great example of how the NAB's come around quite quickly. So it really is dependent on the bank and their turnaround times. Really, some of them are super quick. Like, so I've got approvals within 48 hours, which is great.
As an ex-banker, I can tell you that if your history with your bank has been one of evidencing unauthorised excesses from time to time or on a reasonably frequent basis, it'll be much harder for you to get a response than if you've been the perfect customer and stayed within your limits and your facilities. It's just the way that it's. History counts for a lot.
Yeah, that's
all right.
Yeah.
Well, look, that's about it in terms of questions. We're almost up for an hour, so thanks very much for the questions. Thank you for attending. This will be, recording of this will be up on the HLB community page on our website and also on the LinkedIn community page. If you're not already a member on LinkedIn of the community, please reach out to me and I'll send you an invitation and we'll get you involved in that. Thanks for your feedback, Mike. That's greatly appreciated. And we'll be hosting our next one, same time next Friday. So come prepared with plenty of questions. Apologies for the late invite this week. We'll get it out a bit earlier. There are a few things out of our control that sort of prevented us from getting it out earlier, but we'll definitely be here same time, same day next week. Thanks all for joining us today. Thanks, panelists.
Thank you.
Thanks.
Thank you.